Hey, everybody, welcome to another episode of Money and Stuff. I'm your host, Sam Rodriguez. Hope everybody's doing well. This week, we have Brian on again. Brian, as you know, if you listened last time, is co-founder of Foundation Wealth Partners. We founded Foundation Wealth Partners together. And last time he was here, we had a really good discussion about what we see happening in the market right now. If you hadn't had the chance to listen to it, I'd encourage you to go back about a week. You'll be able to see it. Talking about what we see happening in the market, whether things are overvalued or not, and what you can do about that. But towards the end of that conversation, he mentioned something really quickly about bonds and there, possibly being an opportunity or an opportunity coming up even with bonds. So I asked him to come back on if we could pick up that conversation again. Brian, thanks so much for coming on, man. Really appreciate it.
Yeah, man. How's it going, Sam?
Oh, it's good. It's good. Hey, I'm just going to jump into it. Right. So last time you said you see an opportunity coming up in bonds. I know you and I have talked about that at length. Man, I'm just going to let you take it away. Tell me what you're seeing.
Yeah, well. So I think it makes sense though to kind of go back a couple of years, Sam. Gosh, even almost to like COVID time frame. So to kind of set up and really, because it's hard to understand the opportunity, right? And also, I think it's important to acknowledge that there hasn't really been a big reason, to be overweight bonds, or the fixed income asset class, for years in portfolios because of yields being so low. But what all does that mean and why? I think is the bigger question. So, Sam, why don't you take us back through what happened in 2020? What got us here?
Sure. So, before I jump into that, I think one thing I want to say is people may be listening right now and saying opportunity in bonds. I'm only holding bonds as a ballast to my stocks. Bonds are supposed to stay safe when my stocks are falling, so that way my account doesn't fall as much as the market. I haven't heard anybody say before about an opportunity in bonds, and that's really what we're talking about right now. So prior to 2020, what we saw was the Fed beginning to raise interest rates again. So in order to talk about 2020, I feel like we have to go back all the way to 2009, man, maybe even 2004, right? And talk about how the Fed uses interest rates. So, the Fed has two main requirements. One of those, and the one that we're seeing them try to enact right now, is to keep inflation low. And they use interest rates to try to bring inflation down. So the higher interest rates are, the harder it is for you to finance things. So hopefully you spend less money and it kind of cools the economy off. By contrast, when we go through recessions, like in the early 2000s. So if I go back, like I said, 2004, they started raising interest rates. Before that, they were lowering interest rates because we were in a recession. Then from 04 to 08, they were raising interest rates again to try to cool the economy down. 09, we have the big recession. They drop interest rates dramatically. Then in 09, interest rates were kept relatively low. They kept them pretty low for a while, right? Like 2009 to 2015, they kept them pretty low. Is that right? Am I remembering that right?
Virtually zero. There was no yield. Yeah, so I think it was, let's see here, it was actually 2015. Okay. 2015, it was some slower and smaller rate hikes up until COVID hit, and it was back to zero again.
Yeah. So COVID hits, everybody's scared that the economy is going to completely collapse because we basically shut the world down. You couldn't go out and spend money. So rates dropped dramatically. That's why you have a ton of people that have like a 2.5% rate on their mortgage right now, bought cars at super low interest rates. Were able to refinance a ton of debt down to extremely low rates. It was all meant as a stimulus, right? Which gets us to what, middle of last year?
Yeah, March of last year.
Yeah, Fed starts raising rates. The economy's hot. Everybody's finally out of their homes. They haven't been able to spend money for like a year and a half. They're spending money on going out to eat, buying everything, building houses at a super fast pace because everyone can buy a house at a cheap rate. So the Fed sees that, hey, things are getting hot again. We're going to start raising interest rates. So where were we and where are we now?
Yeah, so March of last year, before that initial rate hike, we were virtually at zero. Short-term interest rates were virtually zero, and so in fact, if we look at like December of 2021, let's see here, the Fed funds rate was zero. 10-year Treasury was at 1.5%. So you go buy a 10-year government bond and you're going to make 1.5% on that for the next 10 years, right?
Mm-hmm. Mm-hmm.
30-year government debt was less than 2, and so then, Fed started to hike up interest rates, right? Short-term interest rates. And that's really, when the Fed moves interest rates, we have to remember that, the Fed only controls the Fed funds rate. The market dictates the rest of those yields, right?
Yeah.
And so the Fed started hiking rates, and, where we are today, we're now at, the range of 5.25% to 5.5% on the Fed funds rate. But what's just really interesting is that the yield curve is significantly or extremely inverted, which is kind of hard to wrap your mind around. So, what does a yield curve inversion mean? Simply put, think about when you're getting your 30-year mortgage, right? It's like you get a 30-year mortgage, that, if you take a 20-year note out instead of a 30, you're going to get a better rate, right? Or you would think that you would. A 15-year, you would expect that you get a lower rate than a 30-year, and a 10-year, you'd expect to get a lower rate than a 15-year, right? And just continues. It's a slope. It's a forward slope. And so what we're seeing now is that, the Fed funds rate, or the the shortest end of the yield curve, is at, call it 5.5%. And rates actually start going down from there. So you're not rewarded, for locking in yields beyond, 6 months, really, in this day and age. It's kind of crazy. That's the shape of the yield curve right now. It's kind of mind-boggling, right? So, I guess it begs the question, right? Why would I just not, tell me why I shouldn't just buy a money market fund, And I think that's a logical question to ask. Don't you think so, Sam?
Yeah, I think so, right? I mean, you talk about the 10-year rate being 1.5 when all this started. And I think rates were so low for so long. It was really crazy when we had so many people, if they could get a savings account or a CD that paid 1%, they were jumping on it because you couldn't get 1% for a long time, right? And so now you can get money market over 5%. You can get a CD over 5%. What I would say, what's interesting though, and I think this is kind of getting to the point of where you're going, is go look at those longer term CDs. Go look at an 18-month CD or a 24-month CD, and they're not paying the same as the 13 or the 9-month CD. It's not paying you to lock that up.
You're right. And what's crazy is that if you go out to, 2 years or 3 years or 4 years, you're getting even less than that, 18-month CD, right? And so,
right.
So that begs the question is why are the banks doing that?
Yeah. What that tells me is the banks anticipate the rates not being as high as they are today in a relatively short period of time from now.
That would mean that the banks agree with the yield curve, broadly speaking, right? The yield curve is ultimately telling us the same thing, right? Is that the yield curve for the market, really, because the market is what drives the yield curve. The Fed only controls the very, very short end of it. So the market even believes that rates are going to be lower in the future.
Right.
And I think it's important to acknowledge too, because there's a lot of this talk about, are we going to have a recession or not? And I think that this conversation is kind of irrelevant to that. So I think that regardless of whether or not we have, a recession in a month or 6 months or a year, regardless of the path that's in front of us, I think that we should all agree that, inevitably rates are going to come down. It's just a matter of are they going to go up any more from here? How long are they going to stay there? But ultimately, as a country, we can't afford to keep rates as high, It's really just not in the cards.
Yeah. So I think there's only 3 scenarios I can think of when it comes to rates. One is eventually rates have to come back down, right? And we can talk about what would drive that down. 2 is rates stay where they are. And then 3 is rates go up for some reason.
I think that there's less risk of rates going up another 5% than there is of the probability of rates, specifically, on the Fed funds rate moving down, 3 or 4%.
I want to talk a little bit about why we think rates are probably going to come down, right? So we talked earlier about the Fed raising rates to try to slow the economy down and bring inflation down. And this year in 2023, we've seen inflation very quickly sort of change its acceleration, right? The acceleration has slowed down quite a bit, went from over 7% now down to about 3% very, very quickly. And if that continues, the Fed will not need to be raising interest rates the way that they're raising them right now. And so even if, let's say that inflation stays kind of sticky around 3%, then the Fed doesn't have to be nearly as aggressive as they were when inflation was 7%. But if inflation continues to fall and we get to 2.5%, 2%, then they need to keep that stable. And I think that's where we see them begin to really drop interest rates.
Yeah, I would agree. So, I mean, for me, the bigger picture is regardless of the path, rates are coming back down. It's just, they
Yeah.
might edge up a little bit more before they begin that ultimate move back down.
Yeah. So I think we've given the longest prelude, to
Sure.
get to the point that we're trying to make of that's what brings opportunity in bonds right now. Why don't you talk about why that results in opportunity in bonds?
Yeah. So what I find most interesting about bonds is that we can calculate the future returns of bonds. It's math, right? It's purely mathematics. Because at its most basic factor, if you talk about an individual bond, right? And I'm going to oversimplify it a bit, but bonds are issued in $100 denominations. They mature in $100 denominations, right? And so between issuance and maturity, that price is going to fluctuate from plus or minus $100. Okay.
Mm.
And so, speaking of an investment grade bond, the primary driver of that fluctuation is interest rates, right? And so last year, when interest rates went up from 0 to 5 at an extremely rapid pace, a lot of these, and I call it an intermediate term bond fund, that has durations that, let's call the average duration, a 6, so it would mean like on the aggregate, most of the bonds in the portfolio have about a lifespan of about 6 more years. They saw declines of 12 to 15%, right, on a bond investment.
Yeah, I think a lot of people experienced that last year. So we're talking about opportunities in bonds. And where I mentioned earlier, people mostly having bonds to be the counterweight to their stocks. But in the last couple of years, they've seen their bonds lose money. And last year in particular, bonds lose almost as much money as the S&P 500 did as a whole. So even your conservative investor had a pretty rough year, not that much different than an aggressive investor, right? So I could imagine that people listening to this right now might be a little bit skeptical, so saying, I recently got burned on bonds. Why are you telling me to start adding more?
Sure. So, what's even crazy is that, a longer duration bond portfolio lost as much or more than, the NASDAQ last year. You're talking 30+%. It's insane, And so, but back to that original part, right? So, if I have a bond, and it goes down by, 15%, right? And it has 6 years left to maturity, and its interest payment is, let's call it a 4% interest, a 4% yield based off of a $100 price, right? And it matures in 6 years. Well, we can reverse engineer that and come up with a term called yield to maturity, right? Which tells me like, all right, between now and the time this bond matures, what is my annual rate of return going to look like, right? And right now we're seeing yield to maturities on, just your Barclays aggregate bond funds, run of the mill, right? Which is, call it the equivalent of the S&P 500 for bonds, just your bond index, north of 6% yield to maturity, with a 6-year duration. I think that the other part of that equation though is that well, what if what these guys are saying, Brian and Sam, are right? Let's say that over the next couple of years, rates come down, not even to where they were a couple of years ago, but let's say rates come down, a good bit, right? Whatever that means. And so just like with what happened last year, when rates went up a lot, those bonds went down a lot, right? Well, if rates happen to get cut in coming years, let's forget about a recession. Let's just assume we have a soft landing and all things are great and the Fed starts cutting rates again. The price of those bonds are going to move up. So you may accelerate, that yield to maturity, right? You might get 2/3 of that return, over the next 2 to 3 years, right?
I want to stop real quick and talk about that yield to maturity. So, and break it down a little bit. So when you're talking about yield to maturity, for those of you who might be saying, okay, what exactly did that mean? Let's say that you've got a 10-year bond and it's earning 4.1%, right? And its original par or its original price was $100, right? And you're earning 4.1% of that $100. Well, your yield to maturity would include either the premium or discount that you paid to purchase that bond. So if you were able to buy a bond that's going to mature at $100, but you were able to buy it for 96, you'd include that $4 discount that you got into your yield, right? So yes, you would be getting 4.1% of $100 on that bond that you bought, but you'd also have to include that you're going to make that $4 because it's going to mature at $100, but you only bought it for 96.
Exactly. And so you look at the Barclays aggregate bond index, right? And I just pulled it up, Sam. So the average price is about $88.
Mm-hmm.
So there's a lot of room to run.
We should probably explain like remember when we took the Series 7, the sort of seesaw, like in the way that bonds move? That's probably the simplest way to explain the way the bonds move and why there's opportunity in there.
Sure. And so,
you want me to do it, or you want to do it?
I'm happy to do it, right? So you think about that the old bond teeter totter, right? So playground math, huh? So
That's right.
you sit on the teeter totter. If you consider, let's call it the right side of the teeter totter as we'll call it interest rates. And if you can imagine, the left side of the teeter totter is the price, is your bond, not the interest, but just the price of the bond, whatever it's worth.
Mm-hmm.
And so now I like to go a little bit further in my teeter totter example and draw a line, make 3 bonds on it, right? Also on the bond side, I like to have a bond really close to the fulcrum. I like to have a bond in the middle of the teeter totter, and I like to have a bond at the end of the fulcrum. And the reason I like to do that is so I can kind of explain the difference between shorter duration and longer duration. But ultimately,
mm-hmm.
you got the teeter totter. On the bond side, you got 3 bonds sitting on it, one really close to the fulcrum, and one in the middle, and one at the very, very end. So when interest rates go up, right, all those bonds on the bond side, they go down, right?
Mm-hmm.
And so the one that goes down the furthest, though, is the one at the very, very end, because the one that's very close to the fulcrum doesn't move a lot. And the reason I like to include that is because that one closest to the fulcrum would kind of be like think of a money market fund, right? It's like the price of the
mm-hmm.
fund isn't going to decline if rates go up, just the yield is going to go away, right? And so, but on the opposite end of the spectrum, when those interest rates come down, that side of the teeter totter is going to go up. So I guess out of respect to time, man, like I think might be fun to talk a little bit about like, so what does that mean? What are the actionable takeaways here for portfolios? And I'd say like, well, first of all, I think it's important to acknowledge and understand, how bonds work. And, if you're not grasping what we're saying, schedule some time to talk with us or your advisor or something like that, because
mm-hmm.
we still have, a significant portion of our assets in very, very short maturity bonds, in money markets and things of that nature, right? But what we have been doing is just kind of strategically, dollar cost averaging and adding some duration to portfolios, because we don't know, no one does, when the Fed when this madness is going to end, right?
Mm-hmm.
But what we do know is that at this point in time, my yield to maturity, is actually a really palatable number. So this is an example, okay? Let's say interest rates come down by a percentage point. You stand to make 8,
mm-hmm.
And so when we're in the environment that we anticipate rates declining, they could edge up a little bit more and stay there for a while, which, by the way, we're going to get paid while we wait. I feel like bonds represent an opportunity, and I think that the investment implications are start to build in some duration in portfolios, but just be reasonable and intelligent with it.
Mm-hmm.
What do you think, Sam?
Yeah, I number one, I'll say I agree with you, right? Number two is I'll say, bonds work different than stocks, right? They're a completely different animal. They're only related in that usually when stocks go down, bonds go up, right? And that may, I should make that point too. That may not be the case this coming year, right? There are definitely times when stocks and bonds go up at the same time, right? Just like we saw last year, there were times when stocks and bonds go down at the same time. So it's completely possible they could both be going up.
Right.
But one of the things I think is important to know about bonds is, you're right. If the Fed raises rates another quarter or another 2 quarters, right, it's possible you could see, if you're extending your duration right now, buying longer term bonds, 7 to 10 year bonds, it's possible you'll see that price come down, and you may get a little frustrated saying, oh, I heard Sam and Brian saying that there's opportunity in bonds right now. It's important to know we're not saying that, hey, we know this is about to start making money right now. What we're saying is, it looks very likely that the Fed is going to start dropping interest rates at some point in the near future. That could be 3 months, that could be 6 months from now. And when that happens, here's what we'll see begin to happen with bonds. So more what we're saying is, you can buy this yield right now, you can buy it at a discount, and we don't know exactly when it's going to work, but likely a year from now, you'll be happy that you were owning those bonds, right? The shorter term, there could be a little bit of pain short term, but I think you have to at least keep a 12-month perspective if you're employing this into your investment strategy. Number two is, rates move very slowly on the downward slope. right? So I don't want anybody to panic and say, oh my gosh, I got to start like flooding into bonds right now, or why aren't you guys extending the duration on my bonds all right now? Well, like Brian said, we don't know exactly when this is going to happen. And even if the Fed comes out and drops rates 0.25%, it's likely that they're going to continue to drop rates for some time, which means there will still be opportunity to take advantage of as time goes on. Just like stocks, very, very difficult to catch at the peak or trough. It's just important to have a strategy. And I would say, man, that's another big thing right now that I would say is it's very important to have an overall strategy. Yes, it's very important to be diversified, but it's also important to know within that diversification, what are you holding and why? So it's not just enough to say, I've got a 60-40 portfolio, 60% stocks, 40% bonds. It always is, well, what type of stocks are you owning right now, right? What type of bonds are you owning right now? Because they don't all have the same opportunity, right? So I think it's very, very important to not just sit on your account and think, I've got a 60-40 portfolio, everything's going to be fine. Dig into that account a little bit, or talk with your advisor, talk with somebody like us and say, okay, what am I holding? And with what you're seeing in the future, what you're seeing happen with interest rates, how would my portfolio react to that?
I agree, Sam. I was just going to say too, like how like earlier this year, like the consensus across the board expectation was is they're going to start cutting rates now, like this time this year.
Yeah.
And so like how that can shift expectations, just like from all the smart people, could shift so rapidly.
Don't be surprised if the Fed doesn't continue raising rates based on the reason they're raising rates right now, right? So, yes, we have inflation, but what they're seeing as really sticky right now is consumers are continuing to buy. And that's kind of, I don't know the right word. I don't want to say it's confusing the Fed, but it is a little bit confusing, right? We've got, prices were up, wages have come up, but not that high, but people are continuing to buy. So you really start to question, well, is raising interest rates really having that much of an effect on inflation? Because people don't seem to be slowing down their buying. And what you see is people on the higher end of the income scale have rebounded much quicker than everybody else when it comes to the inflation that we've seen. So the way you rebound on inflation is you make higher wages. And people who are already on the high end of the income scale, their incomes have gone up while everybody else's has stagnated. Well, it just so happens that those people on the higher end of the income scale happen to also be the people who spend more money on things. And so those people really continue to push this economy forward by continuing to spend money, because people are spending money and it's not driving inflation higher. We're still watching inflation fall, right? So I think all of that lends itself to rates are likely to fall fairly soon, even without a recession.
100% agree. And that's why I think it was important to kind of go through this discussion with that kind of assumption, right? But even if you happen to be, or if we happen to have a recession, I think everything that we just said is just accelerated, right?
Yeah.
Bonds look even better, so I'm glad you brought that up. That's a good point to make. So anyway, this has been good, Sam. Let's do it again soon.
Hey man, I know we've also been talking a lot about defined outcome strategies. I think next time we get together, let's talk about that. Does that sound good?
Sounds good, man.
All right, dude. I appreciate you coming on. Everybody, thanks for listening. We'll see you again next time.
See you, Sam.